Is technical analysis pseudoscience? I know 50% of traders think, oh, no, it isn't. And 50% will tell, yes, it is. It's a pseudoscience. And I know this is the tough question, but now in this video, I will share my opinion. Hello, this is Igor from FX Igor YouTube channel. And today, I will try to give a few answers related to pseudoscience and science and technical analysis. First, we know definition of the pseudoscience. Pseudoscience lack the rigor essential scientific method because the science is based on fact, while pseudoscience just the claims. And in the science, the subject is systematically organized knowledge in the form of explanations and predictions which can be tested. This is very important, can be tested. And when I say science, you will always see some guy with glasses and writing some very complex things on the board, and you don't understand nothing. But it's not a science. Science, for me, is a system, is methodology. Science is something that's very hard, but people try to give the answers using the science all the time. And on the other side, there is a pseudoscience. You know, there is a lot of people that they image the earth like this. Say this. They think that the earth is like this. They see earth as a flat. Can you imagine? There are people that they believe that you will be selfish if you're born at September. Or you will be the stubborn if you're born at May, you know, because they see if you are Cancer or if you are twins or I know what sign or symbol that will determine your life or something like that. It's a stupidity. It's the stupidity, like when I watch and I try to watch your hand or your fists to determine your future or something like that, or how many kids you will have. It's all pseudoscience. But what we think about this is technical analysis of pseudoscience. Technical analysis is a form of security analysis that uses price data and volume data, typically displayed graphically in charts. So the charts are analyzed using various indicators in order to make investment scenarios. Like now you see a chart, you see a cup, you see a breakout, you see previous bullish trend, now you see a bearish trend. So we analyzed past, what happened in the past. This is the technical analysis. And we try in the future to create scenarios, to try to figure out important levels, entry positions, stop loss, target, to think about market, to connect sometimes fundamental and technical analysis to be decision makers. But I want to tell you about 3 assumptions, very important for technical analysis. I know that everything started from Dow, and I know that a lot of people tell, oh, Dow theory is not a theory, there is no science there. Of course, but there is one catch. Technical analysis has 3 main principles and assumptions. The first one, the market discounts everything. This is true. So what these assumptions wants to tell us is you can have very bad news about fundamental news, the bad industrial production, the low interest rate, something stupid. No, it's not important. And after that, instead of bullish trend, we can have bearish trend. Or instead of bearish trend, we can have a bullish trend. What that means? Means that the chart and price is only things that it matters. So the most important thing is price. Price is like a mirror. You watch you in the mirror, you are pretty or you're ugly, but this is the mirror. This is the most important thing. And I think that this assumption is true. So the final answer is always on the chart. Price level is always the real price of the commodity, of the forex, of the stock, or anything. Of course, you can calculate on instant value and tell, okay, this stock should be $7, now it's $15, it's not good, or it's good, and this is it. But the final price is $15 or $7. This is it. You have a final price, you have a real live price right now, and this is the real price of that asset. Stop, period. The next assumption, prices move in trends and counter trends. Of course, we can see that there is a seasonality, there is a trends and counter trends on the chart. There is a proof, mathematically proof for that, because we can spot the trends. It's very hard to predict what trend will stop, but one thing is for sure, on the chart, you can spot and you can define the trend and counter trend. This is the fact. And the assumption is good. There is a truth for that. This is not like stochastic earthquake chart when you cannot know what will happen in the next few minutes, seconds, and etc. But here you can see a trend for last 6 months, trend for last 3 months, trend for last 12 hours. And the last one, the price action repetitive with certain patterns recurring. Of course, we can spot, we can find the patterns on the chart. We cannot know outcome all the time. But what I can tell you, it's if you see, for example, bullish engulfing pattern on a daily chart, I cannot tell you that always will be bullish trend after that. No, but I can tell you, in last 25 years, always when we have bullish engulfing pattern, I can tell you that market was bullish in 55% or 56%. And I have statistical proof that there is a higher probability that market will be bullish than bearish if we see engulfing pattern. I cannot predict for sure, but I can give you some kind of scientific evidence using the basic statistical methods. And this is it. So on the other side, we have a fundamental analysis. It's a method of evaluating the intrinsic value of the asset and analyzing the economic factors that could influence its price in future. Macroeconomic statistics such as inflation, interest rate, CPI, industrial production, and etc., have the greatest impact on forex market. This is true. There's no problem. But there is one very important moment. I know there's a lot of traders right now, and that traders will tell me like this: "Hey Igor, fundamental analysis, it's everything, because everything starts from that. You can predict the market using fundamental analysis." I will tell you no. You cannot predict market easily using the technical or fundamental analysis or both, etc. No, it's tough. It's very hard. And a lot of times you can have industrial production increase by 10%, and then after that you can see the market just goes down. Why? Because traders decide that. Sometimes you have a great news, but big dogs want to sell. And this is it. This is something that you cannot change. Of course, if you have fundamental macroeconomics news, one news, second news, another news, everything is great, everything is good, and price is still low. In a couple months, you can see the bullish trend and more bullish trend, because you see, for example, the market is recovering, etc. Of course, there is an impact. There is some statistical facts about fundamental analysis. But like I said, I cannot tell you that 80% I'm sure that something happened. It will always be something between the 50 and 60%. And this is the fact. Like a technical analysis, fundamental analysis is not something that has high accuracy. I will give you just an example. Interest rate. First, what is the interest rate? A forex interest rate, carry trade, is where a trader borrows or sells a low interest rate currency in order to purchase another currency with a higher interest rate. Very simple. You have euro, for example, 10% interest rate. You have a dollar, for example, 1% interest rate. I'm sure that because you have a $10 against $1, the people and companies from Europe will start to buy cheap dollar US companies, and very soon euro will become very strong and more stronger, etc. Because interest rate has a great impact in currency. But you cannot predict the market only using interest rate for sure. For example, Bank of England set for biggest rate hike in 33 years, but economics expect dovish still. This is the news for just a couple days ago. What's happened? Look this chart. British pound, US dollar goes down. British pound is down. Problems with British pound. And at the same time, the interest rate is the highest in the last 33 years. Why is that? Because British government tried to fight against inflation. And US dollar and British pound, everyone's increased the interest rates. But this is not the proof that I can for sure will tell you, oh, British pound will recover because they increase interest rate. There is a higher probability, but I'm not sure. Just look this. No strong bullish trend. Do you know what is this? This is the risk analysis chart. Risk analysis is a part of management. It's a scientific method. Look this. Do you know what is this? Question. Is risk analysis pseudoscience? Is technical analysis pseudoscience? The both answer are Risk analysis is part of science, technical analysis is part of science. Because using the technical analysis and the risk analysis, we create the scenarios, we create probabilities, we analyze, we observe. We don't have high accuracy models, but we just need to use this to explain some things. You cannot tell this, oh, look this, if you have 90% prediction model, this is science. Oh, you have only 53%. Oh, this is not science, it's a pseudoscience. No, pseudoscience is something else. It's a really rubbish nonsense. But this is analysis. You create scenarios. This is very important things. And like I said, we can create what-if scenarios all the time. We can create the charts. We can create entry points, stop loss, targets. This is our goal, to find important price levels, to create the most possible scenario. But like I said, when I say most possible, I think 55% will be bullish, 45% I think will be bearish because of this, and this. And all these analysis can help me to, on the end of the year, I have some kind of profit, to be more on the right side and less on the wrong side. And for the end, I just want to tell you that the two major problems why we think the technical analysis pseudoscience is two things. The first one, definition, and another, expectation. Let I try to explain this. What is our expectation for technical analysis? A lot of people tell, oh, I want to predict the future. I want to know 80% what will happen in the future. If you think that this is technical analysis, it's wrong expectation. No, my friend, 54%, 55%. If I risk $1 and want you to target $1 and I have a model of 55%, it's a very good. And people need to know that we can use technical analysis as a part of a machine learning method. So we can put fundamental data, we can put technical analysis data like relative strength index, MACD, prices, volumes, etc., to create some machine learning method to try to predict what will happen in the future based on that. But believe or not, if you create a great model, test that model in unseen data, etc., on the end, you will have some model between 50 and 60%, and this is success. And you know, like I said, if I have low probability model, it's not that I am pseudoscience, it's only low probability model. And another thing, like I said, is not just expectations, definition of technical analysis. In definition, technical analysis is not crystal ball for future prediction. Technical analysis is only analysis. When I try to analyze the market, I try to, like I said, determine stop loss, entry point, target. This is my goal, and this is my major goal. And then to see what is the most important thing, where is the best area to enter into trade, are there any important news that can change my opinion, etc. This is the analysis, not crystal ball for prediction, for sure. However, I know that a lot of stock traders think against me. I know that a lot of traders have different opinion. I respect your opinion. Please, you can write a comment, and please, you can read my article just below this video. I wish you a great day, and bye-bye.